Options. What we don't know can hurt us. I don't know who said that, but somebody did. Why is that important? Well, it's like a lot of things in life. If you don't understand something, you'll fall for anything. And the options market is sometimes a difficult market for most people to grasp, but it is also a place where people can easily fall into. And if they don't have a good grasp of the terminologies and how that market works, it can turn it into a pretty painful investment experience. And the only true security is the development of your skills. That's what Aristotle said. So on that basis, we're going to spend a bit of time now just going through the fundamentals of options. Before going there, I'd just like to quickly introduce a recent study of some option users. This was commissioned by the Options Industry Council in Chicago. The study was conducted by the Anklevich Partners and it was released on May the 5th, 2000. The results from the study were quite interesting. They found out, first of all, that option users remain predominantly male, about 90%, and the option users perceive themselves as knowledgeable about investing. About 81% had that perception. About half, 51% of the non-users of options felt it was their lack of knowledge about options that prevented them from investing with options. And the non-users also still mentioned risk and fear of the unknown as barriers to the options market. Now, the options history. Options started in Chicago in 1973. They started in Australia in 1976. We were the first country outside the United States to establish an equity options market. And at that point, it was just call options only. The introduction of put options happened in 1982, and currently there are over 74 companies listed on the ASX that are option stocks, and that list is ever growing. So why don't more people take part in options trading? That's often a question. Well, there's probably two key reasons, at least. The first one is the brief history of the options market has kept it out of the public eye, at least in the past. And probably the other main reason is that the language of options is highly specialised. When language is overly technical, it is easy for the average person to feel alienated and intimidated. In other words, it can easily create fear. And probably another reason that a lot of people aren't trading in options is just the fact that the majority of private client advisors are not ASX derivative accredited. And as such, they are not in the position, therefore, to make investment recommendations to their clients in the derivative market. Now, the agenda for this module, we'll talk about what are options, the option fundamentals, basic option strategies, and the strategies that we talk about are buying calls if you're bullish and buying puts if you're bearish. Warrants versus options, and then just some trading tips in the basis of what we've discussed, because we're just going to focus on straight out what I call vanilla options trading, just the buying and selling of calls and puts from a trading perspective. So what are options? Options are derivatives. Options derive their value from the underlying security. For example, Telstra options derive their value from the movements in the Telstra share price. There are three key elements of an options contract. The first one is there's a fixed quantity. Typically, one options contract will equal 1,000 shares. That'll happen 99% of the time in the market. There are times, however, that one options contract may actually equal less than 1,000 or even more than 1,000, and that will only happen if there's been some sort of a capital change to one of the listed companies. For example, when BHP merged with Billiton, that changed the actual contract weighting, and that 1.1 options contract equaled 1,046. But most of the time, one options contract equals 1,000 shares. There's a fixed price, which we call the strike price, and of course they have what we call a future date. Now, options, that's share options, they expire on the last Thursday of the month, unless, of course, the last day of the month happens to be a Thursday, and then it'll be the week before. So there are three key elements to an options contract. Now, why do we deal in options? Well, there are five key reasons. The main one is leverage. Leverage is the single most outstanding feature of options and warrants. Another reason to invest in the options is for insurance reasons, the limitation of risk, hedging, and income generation. An example of a hedge would be somebody who might own, say, 1,000 Woolies shares. They've recently decided to sell them at $13, but rather than take the money, they just want to make sure they have a bit of a position covered. So they go out and take, say, $500 of that $13,000 that they've realised and buy a couple of call options on Woolworths. And if Woolworths were to continue to rise in value, they can still capture that upside, just a little bit of a hedge. The income generation is what I'll talk about in actual Module 4. So what are options? Well, an option is either the right to buy a share, and that is known as a call, or the right to sell a share, that is known as a put, for an agreed price, which we call the strike price, on or before a predetermined future date. That's called the expiry date. And the reason a call option is called a call option is because if you own a call, you have the right to call shares away from someone else. And the reason a put option is called a put option is because if you own a put, you have the right to put shares onto someone else. So that's where the wording comes from. It is important to understand that the buyer has the right, but not the obligation, to exercise the option. The buyer can exercise their right at any time. And that's important because options traded on the ASX derivative market are American in exercise style. And what that means, an owner of an option can exercise that option early. They do not have to wait until that option's expiry day to exercise. They can exercise early. Just to continue on, now the seller of an option has an obligation to fulfill the requirements of the contract if called upon by the purchaser of the option to do so. For this obligation, the seller of the option receives a consideration which is referred to as the premium. Sellers or writers of sold open option positions are also margined by the options clearinghouse. We'll come to margins a bit later on in the program. Call and put options. Now, as the stock price rises in value, call options also rise in value and put options decrease in value. As the stock price falls in value, put options also rise in value and call options decrease in value. And that makes sense because when you buy a call, you have the right to buy an asset. If that underlying asset goes up in price, the value of that option naturally goes up with it. And vice versa, if you buy yourself a put option and the underlying asset decreases in value, the value of that put option will also increase. Leverage is the single most outstanding feature of options and warrants. That's what attracts people to the options market, particularly from the trading point. And the fundamentals of options also apply to warrants and index options. Now let's just talk about this leverage for a moment because this is quite important. Let's say ABC stock is now trading for $10 and there are also some ABC $10 call options and they're currently trading for 50 cents and there's 3 months until options expiry, so we've got a little bit of time there. You decide to go and buy 1,000 ABC shares, that'll cost you $10,000. On the other hand, you could go and buy yourself 2 ABC $10 call options and the total cost would be $1,000. Now let's say your stock, ABC, rises to $11. What's your profit? Well, if we have a look here, the profit in the shares would be exactly $1,000 because you've bought the stock for 10 and you've now can go and sell it for 11. There's your 1,000, so you've made a 10% return. What's the profit in your options, however? Well, the ABC $10 call options would now be worth $1.10. Now, the profit there for you is $1,200. And why is it $1,200? Well, it's quite simple. You initially invested $1,000 buying 2 options at 50 cents each. Now they're worth $1.10 each. So 2,000 times $1.10 gives you 2,200. That means you've made a return of 120%. So there's an example of the power of leverage. That's what attracts people to the option market. The idea of a minimal outlay and to get maximum bang for the buck. That's basically how they look upon it. But of course, there are also some traps that investors need to be mindful of, which I'll come to a little bit later on. Just to keep on with the definitions, what are warrants? A warrant is an options contract which is issued by a financial institution and traded on the ASX equity market. Like options, warrants are either the right to buy a share, again a call, or the right to sell a share, a put, for an agreed price. They have a strike price on or before a predetermined future date, the expiry date. However, unlike options, warrants are generally not permitted to be short sold. This means that an investor must own the warrant before they can sell it, unlike in options where you can actually sell an options contract and not previously own one. So that is an important distinction. And I also mentioned that warrants trade on the equity market. They trade on the same market that you would be buying BHP shares, whereas options, the exchange traded options, they actually trade on the options market and they have a different settlement period. Just to continue on, what are index options? Options can also be traded over the stock indices instead of individual stocks. Index options give investors exposure to the share price index. That's the XJO. Index options have some important differences with stock options, however. And the main ones are that the strike price and the premium are expressed in points. 1 point is equivalent to $10. Whereas when we're looking at options over shares, they're actually traded in dollars. Index options are what we call European and exercise style. That means you can only exercise your index options contract on the options expiry date. They cannot be exercised early. The RTs, the registered traders, they predominantly control the index market, but like most things, as education brings out more people and more retail investors come out, that is growing the market. And the other thing is that index options expire on the final Friday of the quarter. So they're a quarterly option series. So that would mean there would be an expiry at the end of the March quarter, the June quarter, the September quarter, and the December quarter.